Hello, good afternoon.
Hi, good
Welcome to
afternoon.
this episode of, managing money and everything. Thank you so much, Chidera. So as just a quick show of hands, any of us in the class last week, I just wanted to see how easy was it to actually identify or rather to follow your money from source to the end. Just want to hear if anyone's able to kind of categorize and see, oh, I had excess here, or I need to re-strategize, put more here, take less there. Anyone?
Well, good morning, everyone. Can you hear me?
Here, loud and clear. Go ahead, please.
Yeah, Sa'id, I want to appreciate you and the team for the great work. I started working on the Excel and then did some adjustment based on my own personal finances. So I'm just waiting for salary to land, and then of course from there I'll start
Practicing.
implementing actual
Yeah, awesome.
actual and
Awesome.
I have here with me two of my friends, my colleagues actually at work. We are at work, my colleagues, and we are really getting from you. Thank you very much.
Awesome. We appreciate you. Any feedback just before we start for today? I don't want to keep us long for today. Any other feedback? Well, no problem. We have the retrospective class next week where we'll sit and discuss. I'll just watch you do your thing. You have all the questions you have and concerns. I'll be taking them down. So we've done identifying what investment is, more like investment 101, identify opportunities in the market. We said you're not too young to start investing. And of course, you don't earn too little to start investing. No matter what you think you earn, there's always a portion you can use to invest and grow your asset. So the goal, the whole class is to aid your journey to financial goal or your financial achievement so that you know what you could better say I have that sleep well money, if I can borrow that phrase from Chidera. I love it so much. Sleep well money. It's fast becoming like a one-liner for me. So we've done identifying investment opportunities. We worked on budgeting. This is being able to see the source where our money comes from and where we're channeling it to, and trying to trap more like the excess and invest, right? So now we're on the third topic, which is asset allocation and risk management. But I'm going to start from the bottom, which is risk management. Now that you know that no matter how little or how much you earn, there's need for investing. You've now had a budget to track what goes to what. Now you've been able to allocate funds for investment, right? So we need to consider risk. So most people before now they think risk is something that totally translates to loss or something. No, but risk in a nutshell is more like identifying the possibility of what could go wrong with this investment, with this plan, or whatever we're doing. Because well, I like to say that it's not possible to eliminate risk 100%, except we don't want to try at all to achieve that goal. But for everything in life you set your mind to achieving, there's an element of risk, and although we can plan for this risk event and also mitigating it, but trust me, we can't lock it 100% to say this will happen. So there's always a margin of risk, right? Hold on, what's happening to my slide? 1 second. Okay, so what is risk, right? So we have an objective. This is what we want to achieve. Then what is the possibility that something can derail or delay this objective? So we've created room for possibility. Something can go wrong, right? So if this thing should go wrong, what is the impact? Is it going to set me back? Is it just going, I'll have learning points, dust myself up and continue? Or is it going to be a red flag and nothing major? What's the impact? Then the perception after the impact, right? That's just what we're trying to manage today. So that's why we didn't say risk elimination, rather we said risk management. And also for those that are joining us for the first time today, please feel free at any point in time to just interject if you have questions, right? So we said risk is the possibility that events occur that affect the achievement of strategy and business objective. Strategy and business objective in this scope is actually our goal, which is investing in the long run, right? because it will be so heartbreaking if you're able to work on your budget, you'll be able to squeeze out extra funds, then we'll drop it somewhere that we either lose our principal or we don't get that objective, right? That's why we say let's bring the leg of risk, more like awareness. So risk management. If you see this picture, although we try to get the best of it, this is a lady, right, walking on high wire in 1974 between Twin Towers, which is 1,150 meters above ground level. So identifying risk. What is the obvious risk we can see here? The first one that comes up is falling off, right? But our goal here is to walk between the Twin Towers and set a world record. So how has she mitigated this risk? I wish you had a clearer picture, but you can see the balancing stuff she's holding. This is to balance her weight on both ends. And there's also another rope on her waist down to the line she's walking on. Those are mitigants to say, okay, if this eventually happens, I won't fall off. I have this stick for balancing. Then second one is for holding me to the main line until rescue arrives and all that. So people take risk. That's what we're trying to say. People knowingly take risk and measure vis-a-vis the returns to achieve their objective, right? So historically, risk, anybody that hears risk management is about downside and losses. Oh, when you hear risk, it translates to loss, right? But the focus of risk management today is the identification of opportunities to reach your objective. These are the opportunities I've seen that will aid me to achieve my objective. Then the next thing is identification of the threats to achievement of my objective. If we close the scope now, our objective is to be able to earn, or rather to be able to balance what we earn so we're able to invest, right? That's our objective. What are the threats? If we spend without tracking where the money is going, or if we save or invest after spending, those are threats to achievement of our goal. Because last week I said it's inverted. You spend after you've invested, after you've paid yourself, whatever is left, you try to fit that into your scope of livelihood without compromising your quality of life, right? So how do we identify the threats to our objective when it comes to investment, right? And just to bring it close to home, right? I have this two picture, right? If you look closely, I want a volunteer from the audience to tell me what is the risk that you see in this picture. Because what do you think is the objective here and what are the threats that you see? So I'll read it out. Alfred and Mary have planned to meet their friends, Cynthia and Arnold, at the beach. The two couples arrive at 10 a.m. and find an empty spot near the water where it's very cool. They begin to relax, sleep, read, and chat, right? This is like a normal weekend at the beach. So I need someone to try to identify the objective and what opportunities and threats do you see. We're trying to bring this to our scope of investing, but first let's try to identify this. Feel free, anyone, please.
Okay. I think the objective is for them to have time together, enjoy themselves, spend time together as a couple and their friends. But the risk is they could drown if they slip off, if the water
Awesome.
overflows. That is a risk.
Awesome. I like that. Yes, they're having fun relaxing, but if they lose guard and slip off, there's the danger of someone drowning. Awesome. What else can we see in the picture?
I agree with Justice. But I'll also say I agree with Justice objective. But for the risks, I'll say sunburn. Exactly, yeah, or sunburn.
Awesome.
And because I'm very dramatic, I'll say tsunami. I mean, it could happen. We don't.
Do you swim? Because for you to see tsunami near the beach, it seems aside from the bathroom and a bathtub, you don't do well with water.
No, it can happen here. So we need to be
Yeah,
careful.
awesome. Yes. So it's good, right? We can stay here all day identifying threats and objective, but you get the message. So what's the thing? Like you said, we all agree on the objective, spending a relaxing day at the beach. What opportunities? Catching up with friends, swim in the ocean, sleep, get a suntan. Awesome. And the threat, we said, the heat of the sun later in the day, because they went there 10 a.m. They weren't anticipating sun, right? The water itself is a threat. So how do we mitigate this risk? I can see some mitigant around in the picture. Anyone want to volunteer to point out the mitigants they come with?
Yeah, yeah, we have an umbrella there to mitigate this.
Awesome,
That's good.
awesome. We have an umbrella, and we assume somewhere in the bags we have where we have sunscreen. Yes, it's safe to assume that because you want to tan, so we know there's sunscreen outside to to reduce the exposure to ultraviolet light, which is sunlight. Yes, so that's the mitigant. But if you look at the picture, the couple on the left does not seem to have a mitigant with them. They just came to get the objective, which exposes them to the threats. While the couple on the right seem to have the major mitigant with the umbrella to create shade and all that, right? And well, the next picture depicts what can happen if you don't have mitigants and you expose yourself to risk. So, do we take risk? Yes, we do. But of course, we need to identify the possibility of these things going wrong and get mitigants. You can even see this couple with sunshades, to block out the sun and all that. Yes. So, this bringing it close to objective. So, you have your money now, you want to invest. So, you can start asking those questions. What are the threats that I identify here myself? Then you can get clarification. I feel this is this. Oh, yes. Oh, you're giving me 50% return on 1 million. Awesome. It's a red flag because if you go by your data, we're talking about research, what is the current standard that these financials are doing? We take it from CBN. What is your saving rate in a bank? What is the lending rate? Then bring it close. Other similar investment, what are the current returns on them? If somebody is saying 50%, another says 30, another says 18, then what are they doing differently? It might be a risk, it might be a threat to investment, it might not be a threat. So you now try to find what is the objective. Oh, I need to invest to grow my money, but I'm not out to double the money, right? Your goal is to invest. And investment, the first lesson we talk about patience. You need time to watch it grow, and we spoke about compounded interest. We spoke about compounding interest. Okay, awesome. What questions can I ask? Oh, so you're taking this money, awesome. What assets are you buying? What are you investing in turn? And they answer your questions. Oh, what is the tenor? Because the idea is the longer you stay, the more the exposure to the risk item, right? So is it a short-term investment? Is it a long-term investment? Or you want to invest in X? So what if X fails? How do you intend to return my money to me, or how do you want to give me the interest you promised me? So asking such questions is you actually trying to understand the risk situation. You observe, then you get mitigants to this threat. Okay, they've said, okay, if it goes south, you give us 3 months before you get your money back. Like, okay, is this a risk I can take? Oh, awesome. Depends on your level of risk appetite. Then what are your mitigants? Or maybe I don't want to go long term. Is there a short term alternative I can take? Because every day in life is all about taking risk, and the thing is about mitigating. So here for the mitigants, we have sunscreen, time of the day of you going to the beach. We have the umbrella, we have the sunglasses. So well done, team. It's actually straightforward. you know so now, how do we actually manage this risk? Since I said earlier, it's not what we can eliminate, right? So the first one is to identify, because there's always risk. So the task for you is to identify, how do I know the risk present? How do I assess this risk? Is it long time, short term? Is it immediate? What's the probability of this happening? Then control. Is it the one that's within my control? Or before I invest this money, I've done my research. So I don't want to, or I'm going to only give 30%, or I already have my money in this business or in this scheme. What do I do to control the risk I've identified? Then report and monitor, not necessarily reporting, more like you're evaluating the situation. And it's a circle. You identify, you assess, and see, okay, vis-a-vis my risk appetite, because you all have risk appetite, and I will speak to it, right? Then when it comes to investment, bringing close to home to our scope, you have market risk, adverse price movement. Maybe you, I don't know if you've experienced this, where you go into a fixed deposit and the bank tells you you're giving 8% for 1 year, and 2 3 months down the line, due to monetary policy rates, CBN increase or reduce the threshold, and the bank will say, oh, sorry, we're not able to fulfill our obligation of 8%, we'll now pay you 6. Because most investments will come with fine prints which contains term and conditions and what they can or they cannot do. So market risk is obvious, is everywhere. Then strategic, poor or failed business decisions. This investment I'm doing, is it strategic? Have I checked everything? If it's my field, do I have all data I need to make decision? If it's not, the experts in this field, are they capable? Do they have certification? Are they regulated? Then compliance. Failure to adhere to regulation can also expose you when it comes to business. That's why you see CBN's also saying when you're investing in Forex, you have to be highly knowledgeable in that field. And when it comes to crypto and virtual currency, they've told you if you must deal, then make sure it is a regulated company, because these investments are kind of volatile, right? So if you go ahead to invest in a company that is not regulated by the SEC, that is failure to adhere to regulations, and that's a risk on its own. Then credit, the default of a counterparty to meet principal, interest payment, or settlement. Counterparty here simply means the person you're doing the business with is a credit risk. So if I put my money in a bank for fixed deposit, is a credit risk, because in quotes, I'm lending that money to the bank, right? And what is the risk inherent? They might not be able to meet the obligation to pay back either my principal or the interest. Then operational, how well are these people get together? How well do they function? So I give an example. I go into bank XYZ and I said, oh, I need to open an account. And you hear the manager screaming, tell the security to run down to business center to make copies of account opening form and bring into me. It's already a red flag to me when it comes to operational. Why is your business exposed to a third party to make copies, meaning it's available to everybody? Right. I'm just giving an example. To operational, how well do they hold forth? Or I go to a place, let's say a bank, for instance, and customer service. I said, oh, customer service, I need to do XYZ. And he or she stands up to get something, and the system is open and unlocked to me. That is operational risk. What if my balance is exposed to someone that's not supposed to see it? Because I know the bank, they have my KYC, house address, my picture, and all that, and I want to get my balance. What if that screen exposed to the customer and they didn't lock the system? Divulge my information unwillingly is part of operational risk, right? So these are some things you try um, to look out for. And when it comes to personal concentration risk, right? So concentration risk speaks to the asset class you have in your portfolio, and we're going to discuss the asset class. So when we say concentration risk is okay, have a portfolio, 90% is term deposit, 10% is dollar investment. So now we said you have 90% of your portfolio in one particular sector, and there's a concentration rate in the sense that if that sector should go down, it means 90% of your portfolio is going down. So the idea of balancing a portfolio is to reduce concentration risk. Another example of concentration risk is I have a fixed deposit in GT, another in WEMA, another in Union Bank. Yeah, they're all fixed deposits and they're different banks. One might argue, what is the risk there? What is the possibility of all the banks going down at the same time? Another angle to see it is it's all the same market controlled by similar indices, fixed deposits. So what happens if there's a general change from CBN? It means all those investment, even though they are in different banks, but they're in the same category as TD, will get affected. So while trying to balance your portfolio, you try to reduce concentration risk. So you try to diversify your investment. Do I want to do long term 20%, mid-term 30%, and short-term 50%? So if I mix these assets together, or do I want to do a combination of Cora money market fund, then I want to do bonds, I want to do commercial papers, just so I have a mix of everything. So there's no concentration risk. But like I said, it depends on your risk appetite as a person. How much risk are you willing to take? If you're good with the fixed deposits around banks, and irrespective, you feel okay, what are the risks that can happen? I don't mind if I expose myself to concentration risks, but what are the mitigants I've put in place if this should happen? If something should happen that's going to affect my objective in the long run. Then we have liquidity risk. This is the inability to meet payment obligations or sell an asset. Yes, it's liquidity risk. So when you have money at hand, the term is you're liquid. So I have investments and I need money. How easy is it for me to convert this asset to money, which is liquid that I need to use? So an example of a risk is when it comes to asset allocation. I know I pay my rent yearly and I take a lump sum of money and I invest in a bond that matures in 3 years. The return might be crazy, 20%, 18%, right? But how liquid is that bond if I need to sell to generate money short term for my rent? Right. So there's also liquidity risk, the ability of that asset to be sold to generate money, or the person I'm investing into their business or the organization, how early can they give me my money when I call for it? And when you see most asset managers, like for us at Vested, will tell you redemption is between 24 to 48 hours. For the long-term ones, we tell you 3 to 5 days. So when you read the fine print, you're able to see, and how do you fit this into your risk appetite? Okay, this money I'm putting here, if I need it ASAP, can I wait 3 days before the asset are sold and I get my money back? Or do I need this money within 24 hours? So all those put together will drive your decision making in all this risk identification, right? Other risks include legal, environmental, and social risk, reputational risk, and business continuity. So this last line, when I took it out, is applicable to more of an establishment and not individual, right? But sometimes we could be involved in legal risk. Oh, I'm into real estate. I want to buy land, wait for you to appreciate. Okay, awesome. Have you done due diligence? Do you have deed of assignment? Do you have all the documents you're supposed to have to confirm that you now have rights to this piece of land? Or if it's a house or a building, have you done due diligence? So you don't end up in a legal case to say, oh, you didn't read this clause on clause 7 that says this can only be sold if 5 people should sign a document and stuff like that. Environmental, like we know Lagos, some areas are prone to flood. So before you say, oh, I'm going to buy this parcel of land or I'm going to lease this land and I want to farm because I want to go into agriculture, some form of investment. But have you checked the landscape? Does it get flooded? How much rainfall does it get? So this risk, they go on and on and on, but we can't totally eliminate them. So what we do is to identify the threats, create our mitigants, then we're good. Then when it comes to risk appetite, right? So Sa'id has been hammering on risk, risk, risk. Oh, I paused before I take this topic if I have any question from the audience. Chidera, can help out if I have any questions or by show of hands before I continue on this topic.
Yes, Justice has a question. Justice, you can go ahead, please.
Yeah, say thank you very much. The question I have, you consider somebody that has, because of his or her risk appetite, decides to invest in a mutual fund, money market, to be specific,
Yes.
and knowing that even though money market, the driver, one of the drivers is the MPR, monetary policy rate, and
Yes.
even though and it's highly, as in you can get your money out within 24 hours.
Instant. Yeah, it's liquid. Yes.
So if one decides, okay, let me have a money market fund with Coral, with another one with Zenith Capital, Quantum Zenith, another one with United Capital, ARM, just to spread your risk, and then if anything happens, knowing that you can easily liquidate and then maybe move to an equity fund or move to a balanced fund. So we used to having quite a number of that fund is a concentrated risk.
Oh, yes, I will say it's actually a concentration risk because irrespective of the organization you have, it's still the same type of funds, mutual fund, and it's being driven by the same driver. So, meaning if it affects one from the source, it affects all the money market fund. Because majorly, because money market is the risk is next to zero, right? And bulk of these assets are in treasury bills, which has been issued by the government, right? By the sovereign government, and government controls the money. So if I say, okay, 80% or 7 depending on asset mix, right? 70% is treasury bill, which is issued by CBN, and treasury bill is being sold at 11%. With other assets, let's say for argument's sake, your average return on your mutual fund is 8%, and you decide to put money in all these organizations, you have those giving you 8%, 7.5, 8.6, like that. But remember, the main driver is your treasury bill. So after MPR, the government decides to say, you know what, we have enough money now. We don't need to take money again from the public. So thereby, the rate on my treasury bills go to 6%. So what it means is, so when your fund manager is expanding the scope, because the underlying assets treasurable, they're going to buy that treasurable at that 6%. So what happens is going to affect your own average return on your fund. But remember, you've done one with ARM, another with FSTH, another with United Capital. But treasury bill is the underlying asset they all have. So it's going to affect all your investment across board, right? So that is some form of concentration risk. But this also boils down to your risk appetite, right? So what you may want to do is, okay, I'm trying to reduce concentration risk by not putting all my fund in one organization. Because if they go down, my fund goes with them, right? So the idea is I'm spreading tentacles. So what you could do is, if I'm going to do a mutual fund with FSTH, I can do a balanced fund with United Capital, and I can do maybe equity fund with another organization. So the idea is, if the underlying asset, which is treasury bill for mutual fund, gets affected one way, the two other funds I have with other organization won't be affected. So the idea is, have I controlled concentration risk by not putting all my fund in one organization? Yes. Then secondly, have I controlled concentration risk by not putting my fund in one type of asset? Yes. So Justice, I don't know if I'm able to answer your question.
Yeah, yes, you have, but considering that money market is highly liquid. I mean, if the interest drops, you liquidate and move your money out,
Yeah, you
right?
liquidate and move out. So yeah,
So
yeah. So you can do that. So that's also an option. Which means your mitigant
yeah,
now that you have ready is, if it drops, you just liquidate. So that means you're well prepared for that risk, and it fits into your risk appetite, right? So when we come to risk
yeah,
appetite, we're saying the amount and type of risk that you, an individual, is willing to pursue or retain. I know, yes, this happens, but I'm willing to continue because the objective is bigger. Yes, that's my risk appetite. Then the tolerance is the acceptable degree of variability, or rather, let's say, deviation from the expected level, right? That you're prepared to withstand in order to achieve your objective. So, and this translates to equity fund, because we know how the market goes up and down, it fluctuates. So I can say, okay, come what may, I'm going to go into the equity market. However, my tolerance, right, is actually just 10% of my principal. So I watch the market. If it goes down and somehow it affects my principal, I've already said my margin is 10% of my principal. And when it gets that, that's the maximum for my tolerance. I liquidate and I move on to the next viable investment, right? Then the risk capacity is the maximum level of risk to which organization or individual can be exposed to, right? So let me bring it closer. The risk appetite is the type of risk that an individual is willing to pursue. So I'll tell you a personal story, but please don't adopt it. I have a friend, she's an analyst and she's very good. And when you hear this business seems to be Ponzi, she will tell you how long have they been in business? 6 months, 1 year. She put her funds there. I won't say she's been so lucky, but she takes calculated risk. So our own argument is a Ponzi scheme. Those that come in early get paid. It's the next circle or third circle that gets stuck, and that's our own risk appetite. I put my money here. When you tell her it's 30% or 50%, she drops the money, and she does 3 months, 6 months, 1 year. She gets her money and she's out, right? So that's our own appetite. She's willing to lose all that money in order to make additional returns, right? So our tolerance will be 100%, which is fine by her, but that's totally taking risk. And you have someone else that say, you know what, I'm only going to do business with banks because they're reputable, they've been here for long. And the saying is, the higher the risk, the higher the return. And it's also the opposite is the case. The lower the risk, the lower the return. So you as an investor, what you want to do is to maintain a balance, or say, you know what, this is my fund totally. I can't afford to have 0.001 of my principal affected. So I'm going to go with a low or a conservative fund, which is your mutual fund, which we have currently invested, right? And you can say, you know what, I'm somewhat indecisive. I can do a balanced fund where I have other mitigants, other fixed income assets backing the equity side of it. So if equity should go down, awesome. My fixed income will hold me. If equity should go up, awesome. I make more money, right? So that's how you try to find a balance. They are the types that they're more like their risk tolerance is actually high. They put everything in equity to say, you know what, if I make it, I make it big. If it goes south, then I learn my lesson. So there's no right or wrong way in theory to say this is how you should balance it. It is now, how will I put it? It's now on the individual to say, okay, how do I want to structure this? Because if higher risk is higher return, then how much of my principal am I willing to put under that higher risk to get higher return? Am I going to do a certain percentage? Am I going to do everything, or I'm not going to do any at all? So you to be a seasoned investor is for you to do the rinse and repeat approach. So I do money market fund. I know I get the best out of it if I go 6 months to 1 year. I watch and see, oh, this is good. Then I can say, okay, this is my risk tolerance. I can say, okay, this business is kind of volatile. Can I afford to do a 20% and just watch it? Is it safe? Yes. Rinse and repeat. So over time, you get all this technique you've built that works for you specifically because you know yourself better. You put it together and say, okay, I'm going to continue with a balanced fund for now, right? And like I said during our first class, sometimes sitting down, trying to carve out this risk involves a lot of research, a lot of data, and most of us sometimes don't have the patience for it. That's why most of us just engage fund managers and I ask them, what are the funds you have and what are the risk level? And I try to fit it into my own risk tolerance or appetite. If it fits into it, then I invest and sleep. Let the fund manager worry about the risk because by law, because they are regulated by the SEC, by law, they ought to give me back my principal. Now the option is for you out of all these products, which one fits into my risk and I take it. And the good thing about Vested is if you go to the app, we've already done this calculation and shared it out for you. So if you're risk averse, minimal, we have the low band for you, which you just invest and go to sleep. If you say, okay, you know what, let me take a bit of risk to increase my return, I can do the balance fund. Of course, we have the fund for you. And if you're the one that enjoys the adrenaline rush or you're more like an aggressive investor, you take calculated risk and you can do the equity part, which we all have listed, right? So I don't know if you have any questions. Do you have any questions concerning this?
There are no hands
Okay.
up. There are no questions in the
Okay,
chat.
okay, awesome. So like I said earlier, it's actually risk versus return, right? It said the higher the risk, the higher the potential return. Because now if the risk is higher, the potential to get that return is higher too. So, but it's actually potential to say, hey, it could go south and everything goes down the drain. But the one is lower risk, lower potential return. So the idea of this is how do I create a balance? I know one is low, one is high. How do I create that balance, right? And that takes us to the next one, which is asset allocation. So the idea now is I've broken these funds down. You can do your research to expand. I have the low risk, I have low to medium, and I have the moderate risk, right? I also have the high risk, but it's not on this slide, right? So if you say, okay, my own is low risk, right? And my horizon is actually short term. So by horizon, I mean how long your investment window, how long do you want to invest for? So you say, oh, you know what, I just want to play around. I'm new to the market. Let me see how this plays out. My horizon is 1 year or less. So that's short term. So next you check is what is my risk profile? Low risk. And the good thing about this is there's a risk portfolio questionnaire or some questions that you answer. You just tick, oh, I want this, I want that, and we're able to profile to say, okay, based on your selection, we think you're a low risk person, and therefore we are recommending XYZ product, right? So for someone that has low risk and short-term horizon, usually the investment objective is to seek to generate stable income, then maintain a high degree of liquidity, which speaks to what Justice said earlier, is high liquid. Then what type of assets can I get if this is my profile? You have treasury bills, you have commercial papers, you have bank placements, which is your fixed deposit, right? So if you say, okay, short-term horizon, low risk, now you've seen um, assets that fit into this kind of profile. But then you can also expand scope. Do I want to do what's it called again? Do I want to do thrift contribution with friends and collect later? Also, there's some of it's also a type of consideration you can put if you have the low risk. But for now, I'll just advise for what we have the market, treasury bills, commercial papers, and fixed deposit. If it's okay, my investment horizon is kind of high, is greater than 1 year, but between 1 year and 2 years, or let's just say, just to explain better, greater than 2 years, So I said, okay. And like I said earlier, the major determinant of this time horizon is how early you want to achieve this goal. If my goal is to buy a car in 2 years, then I can come and start from the middle one, which is fixed income. Oh, my horizon is 2 years. So what kind of investment can I go for? Or if my horizon is 2 years, do I want to do the money market for the first year and observe? If I'm comfortable, then I renew for the second year, which I'll achieve my 2 years horizon. Or you know what? Let me just do the 2 years once for all. Choose a business that or a profile or an asset that fits into this, and I invest my money. Then we have the sovereign bond, both state bond and federal government bond. Then you have the corporate bond. Corporate bond are these most of these bonds issued by mostly private. So sometimes you hear people saying Access Bank 2023, Zenith Bank 2028. So the corporate issuing this bond is Zenith Bank, right? Then the maturity of the bond usually follows the name. So if you have your fund manager telling you, oh, we have an asset bank for 2024, or we have a Zenith 2028, they're just telling you this is a corporate that's issuing the bond and this is the term to maturity. And so the investment objective of most people that fit into this low to medium risk is they seek to generate stable income by investing in a diversified portfolio of debt security issued in Nigeria. Because here, bonds are debt security. Think of it as the government or the issuer trying to borrow money from you and say, you know what, aside from your principal that I pay you after XYZ, I'm going to pay you coupons half yearly or depending on the agreement, aside your interest before the maturity of this bond. Then if you say, oh, my time horizon is actually long, which is 3 years or more, then you can actually increase your risk horizon. So the idea of this is if you're to invest in equities and say, let's say there's a dip in the market, but your horizon is actually long term, meaning you can actually wait for the return cycle in which this dip becomes a yield and it grows. So I'll give an example. Let's say I come into the market, it was doing 10%. And after 6 months, it drops to 6%. Rather than panicking and taking my money, meaning I'll have lost 4% of my principal, I have the time, the horizon to wait for that cycle to continue, and that fund comes back to a 10% or does a 15 or a 14 or even better, right? So the idea is if your horizon is long term, then you can actually try to do a bit of equities, corporate bond, money market securities, because even if you come in and there's a bad weather, the idea is you're long term, then that weather might change to the bright side and you earn more money, right? That you have balance or mixed fund. So the idea of calling them balance funds is they try to balance the risk vis-a-vis the reward, right? And the main driver of this fund is the equities, which is the shares of companies or other industries listed on the exchange market, right? So like currently we have the Coral Balance Fund, I think is been like a 28 or a 29%. Before then it went as high as 40, but market is now stabilizing and it's back to 35, right? So if you wait it out, even if market drops to like a 25 or a 23, if you wait it out, there's every indication that it can go back to that 40. So that's why we said, okay, if your horizon is long term, then we kind of try to discourage you from equities because you may not have the patience to wait for the tide to turn, and that means you lose a part of your principal. So as much as possible, we try to mix this asset allocation. So let me use an example of myself, right? Or let me try to build a persona so that we can and we can kind of, I'm trying to find a similar example or bring it close to home so we can say, oh, this is me. So let's build a persona. Name is Jide. Jide is 23 years old, straight out of school, done with NYSC, got a job on a bank as ET. Remember, Jide is 22. And I think the retirement age is what? Someone remind me, is it 50 or 60? I don't have that data. What's the retirement age in Nigeria today? I'm trying to be the persona for Jide.
It's not 65. I was
Oh,
60.
60.
I don't
Someone
know. I
said,
think it
okay.
depends.
Yeah, someone said 60. Let's go with 60. So Jide is 22, just entering into the labor market. Jide is an ET, right? So let's even assume Jide is like the mid class and he gets promoted every 3 years, right? So if Jide starts at ET, meaning in 10 years, Jide is going to be three levels higher and it's going to increase his income, right? So Jide now can afford to do long-term investment with higher risk based on this persona. But we are not all GD because we work hard for our money. But theoretical speaking, because GD is just starting out, the idea is any money GD loses along the way, right? He has the time, the age, the ability to earn it again. So it's more like, oh, since I have potential to earn this money along the line, then I can expose myself to calculated risk. So a GD can want to do full equities and wait out the tide and say, okay, 3, 4, 5 years, 6 years, I'm still here. When the tide turns and the investment is better, I can liquidate, go find the next industry to invest in, right? But equities is kind of dynamic because you don't go in blindly. You need track record of that corporate you want to invest in. What are they driven by, right? So people just tend to do the safe one. You tend to do construction. You try to do telecoms because people, of course, people are making calls and all that. You want to do real estate, right? And tie your funds out long time. So GD can afford to do that. Then let's take a civil servant. Ikene, I apologize if I have Ikene on this call. Ikene is 35, has a wife and 2 kids, is a middle manager, right? So Ikene is 35, meaning he's looking at 25 years now to retirement. Now he has gotten to, I won't say the peak of his career, but to get promoted now is getting harder because he needs to put in more work. He has family at home to spend time with, he's paying school fees. Now you agree with me that the risk appetite of Ikene and GD cannot be the same thing. While GD is more of we outside kind of guy, sorry for using that term, or he has free hands to do more, is only looking after himself and maybe a bit of black tax on the side. Ikene has a family now. He considers them in every decision he's making, and he will be okay. And I don't want to go to money market where I feel the return is low. Vis-a-vis my goal I have on hand and responsibility, Ekene will fall in the low to medium risk and can say, let me time my horizon to 2 years and above, right? What it seeks is to generate stable income. Maybe I get dividends paid quarterly or half yearly, or I get interest return. Because if you check it, if Ekene does not have a house of his own, most likely the goal will be to settle down and have a place of his own for his family, for stability and all that. Then the last person I want to use would be like a Musa. Musa has been with Started his career long time, early 70s. Musa is now 52. 8 years to go. Musa is going to be forced to, to retire. So and you know what happens when you retire? You fall back on your pension, meaning that active source of income is no longer there. So Musa will now fit the persona that's actually low risk because his horizon is short term. In XYZ date, he's going to retire, fall back on pension. Then we can assume what has he put in place? Does he have a side also? Is there a side business going to fall back to? But since we don't have data for that, we say, okay, he's looking at his guaranteed source of income, which is his 9 to 5 employment, and his retirement is fast approaching. He doesn't have the luxury of time to say, you know what, let me take this risk. If I lose the money, I have the time to earn it back or double. So it comes to the short term and low risk and want to do treasury bills and commercial paper. But we can be spontaneous. Will I say we can be dynamic and try to throw these funds around and see, you know what, even though Said said I'm an Ikene, I want to be a Musa, is my money. It's good. Or I'm a Musa, but you know what? Let me try and play a GD and see what comes. And again, that's what takes us back to our risk tolerance and our risk appetite, right? So I take questions, if any, before I continue.
There are no
Okay.
questions.
Okay, awesome. So we have low risk, low to medium risk, and we have moderate risk, right? Then aside this, which are, shall I say, the formal form of investment, so you might also want to look at the informal type of investment, right? Informal can be, you know what, my investment horizon is 2 years to 3 years. I don't want to do bond. I don't want corporate bond. So what can I do? An alternative is, do I want to buy a car on hire purchase and put it out for car hailing business? Do I want to do airport to a destination? Do I want to enroll on any of the car hailing services? It's also some form of investment because I get return at the day vis-a-vis the wear and tear on the vehicle. So some form of investment. Or do I want to finance maybe a farmer to buy fertilizer for his farm, and at the end of the day, I get these commodities which I can sell? Is also some form of investment. So you can actually look around you and see, okay, based on my risk profile, if I want to do a mix of the formal and informal, how do I achieve this? Possibilities are actually endless, right? They're actually endless. So it's left for you to create your own perfect jollof rice recipe, if I can use that term. So I'm taking a bit of this, a bit of that, and I get a portfolio that works for me. And like I love to say, right, because we have the exchange rate risk. However, you put these assets together, always make room for a USD kind of asset, right? Because the thing is, it stands the test of time because the economy is not as volatile as ours, and those indices that move them up and down are they're kind of less frequent compared to naira. So you may want to make some kind of investment in foreign currency, not necessarily US dollar, but foreign currency or foreign bonds. So you can now see, okay, I've also hedged for my concentration risk, which is having all my assets in naira. You've also tackled that. So basically, that is what I have for us today. It's a bit technical, I know, I get it, but feel free to ask me all the questions you have. No, no silly questions, no stupid questions. We're all here to learn. Yes, so Chidera, that will be for me today.